Hey, everybody. Today, I'm very excited to have Mark Maimon on the call today. Mark is the branch manager and team leader for the Mark Maimon team in Los Angeles. And Mark is a veritable expert when it comes to financing options for older adults. And this is kind of a specialized section of the mortgage market because older adults have very specific needs when it comes to financing, specifically tapping into the equity of their homes. So, Mark, thank you so much for joining me on the call today.
Yeah, Seb, thank you so much for having me. I appreciate the opportunity.
All right. Well, I'm very excited to have you here today because you have an amazing podcast, and I've been listening to it for a while. And I just am blown away by all the knowledge that you can share with us today.
That's great. Well, I appreciate it. Yeah, we've been doing this passion project for a while. It's called On the Mark. I'm the mark, I guess, where we interview lots of people in the senior space, some thought leaders in lots of different areas, and just trying to get good education out, just like you are. So I appreciate what you do as well.
All right, very good. Now, listen. So, what I come across very, very commonly is I'll come across a somebody who is an older adult, maybe in their late 60s or maybe mid 70s, and they find themselves with maybe not as much money as they thought that they would have, or as much as they need to, meet their lifestyle needs, essentially. And so a lot of people are looking at different ways to be comfortable in their later years, and then so they're talking to me. I'm a realtor because they're thinking about selling their house, and I always advise people to really never sell your house, right? I mean, like that's what I help people do, but I find real estate works better the longer that you hold on to it, and
Sure.
so, what advice do you have for people who are thinking about selling their house versus looking at other ways to stay in their house longer?
Yeah, I mean, there's lots of ways to do it. I think historically, when people think of seniors and mortgages, they're thinking reverse mortgage is the only option, because seniors oftentimes have difficulty qualifying for loans other than reverse mortgages because their underwriting is predominantly driven by income. And when you're at the point of your life where you're not working anymore, sometimes it's more difficult to be able to qualify for a traditional loan. So we're seeing a lot of trends where, obviously the aging population is getting larger. We're having, obviously, baby boomers are now aging. Some of them are still helping their parents age, if they're fortunate enough. But we're seeing this boom in the population that's having this issue where the majority of their wealth is tied up in their home, but you need cash to pay for care, and the cost of care is rising dramatically and quickly. And some people prefer to stay at home. Some people prefer to go into some sort of community for more, communal living with more, engagement, I would say. But the cost of both is pretty significant, and people oftentimes haven't planned well enough for that. So we're big proponents of people having not just us, but a full financial team, which includes a great real estate agent like yourself, a great lender, but also a financial advisor, an estate attorney. It's so important to get your ducks in a row. But we provide solutions for people to be able to pull equity out of their home, not just with a reverse mortgage. That's one of many options that we have, but there are lots of other alternatives that people just don't even know exist. That it's our job to help them figure those things out so that they can use the equity in their home to help them pay for their care or whatever it is that they're looking to pay for in their older years.
Yeah, so talk to me first about reverse mortgages. So, I mean, there's a lot of, I think, misunderstandings and misapprehensions, and maybe some of them are legitimate and some of them are not. Like, what are the
Right.
pros and the cons of tapping your home equity with a reverse mortgage?
Sure. Well, if I can talk, if it's since it's just you and I, Seb, I'll tell you what I
That's
really
pretty
think.
much all it is.
Right. Um, I'm not a huge fan of reverse mortgages. I think they do serve a purpose. There are some situations where that is the right fit for a family, but I think they're used too often. And primarily because the education isn't out there, that there are other alternatives. So the things that I do like about reverse mortgages, the most common reason people take them is because they don't want to make a payment, right? Meaning literally shell money out every single month to make the monthly payment because I'm not working, so I can't afford the payments. But on a reverse mortgage, what happens is the payments get built into the loan, so you're not actually making an out-of-pocket payment. Some of them can actually give you money every month, but the problem is that the good part is that you're not making a payment. The bad part is that you're not making a payment, right? So what happens is your interest starts to accumulate on top of interest, on top of interest, on top of interest. And so it's the opposite of, for example, when you're investing money in, stocks and bonds or other types of investments, that's compounding and working in your favor. When you do it on a reverse mortgage, it's compounding and working in the lender's favor because you're increasing the debt at a more rapid pace the longer you're in that loan. So that's my biggest beef, so to speak, with reverse mortgages. They're also a little limiting in terms of the percentage of leverage that you can get against the home's value. Um, they're not so easy to hand down to heirs if you want your family to keep the property in the family, so to speak. Your heirs would have to pay off that loan shortly after you pass. And they might not be in a position to do that. They might not qualify on their own to take out a new loan. But also it takes away a little bit of the flexibility. So it's really designed for people that want to age in place, because there's one of the most important requirements is that, when you and I get a loan either for ourselves or for a client who's just buying real estate, let's say it's not a senior, they can claim a property as a primary residence, live there for a handful of years, and then move out and do whatever they want with the property. They don't have to change the loan. With a reverse mortgage, you do. So not only do you have to live there while you're getting the loan, but as soon as you move out, let's say your care needs are higher, you need to move into assisted living or memory care or whatever it may be, that loan has to be paid off within roughly 6 months. And you may not be in a mental position to take out a new loan at that point. You may not have family members who are willing to pay it off or help co-sign or whatever it may be, but you're going to be forced to pay off that loan. And what oftentimes happens is people end up selling the home while the senior is, in deteriorating health. And then they end up paying a massive capital gains tax bill, because a lot of the seniors who are aging now have owned their homes for a very long time. It's a buy and hold type of generation, maybe 30, 40, 50, 60 years. So imagine if you bought a house, let's say in the Bay Area, for example, or Los Angeles or wherever it may be, you bought the house 50 years ago, you probably paid $10,000, $20,000 for it. It could be worth millions now. And we've had cases like that where people came to us and said, industry professionals said, God, I wish I would have known that there was an alternative, because we had a 97-year-old person who sold their home with probably 6 months left to live, wrote $1 million check to the IRS for no reason. Not no reason. They owed it because they sold the home. But if they had waited until the senior passed and then sold it, they would get something called a step up in basis, which in many cases can eliminate the capital gains tax. So there's a lot of things that we do, and they're really rooted in deep understanding of financial planning and taxation and estate planning, that most people just don't even think about. So they make decisions because they need to pay for care, so they sell the home, but then they cause other issues that might be avoidable that will end up making that care cost a lot more. That person's care cost them over $1 million. So for a
Yeah,
year or two
and
of care.
so I was talking to a reverse mortgage person just yesterday about my parents, and my parents have not asked for a reverse mortgage or whatever, but I'm thinking, like they're 81 and 82 right now, and I'm thinking, well, like they may not be able to age in place much longer, and they might need to go somewhere, and so I was, at least one of them anyway, and so I was just running some numbers by, with a reverse mortgage specialist, and I was surprised how little would actually be lent to them based on their age, right? Like it seems like
Right.
that wouldn't really last very long, really. Maybe just like a couple of years, right? Maybe 3 years, maybe, right?
Right.
After they have to pay off their first mortgage, right? With the reverse mortgage, right? Which is then like it's compounding in reverse, which a lot of people don't really understand. Like, was it Einstein who said like compounding interest is one of the fourth wonders of the world. What did Einstein
Yeah,
say,
it's the
right?
eighth
Like,
wonder of the world.
right,
Yes, and it's true.
exactly,
It's but
right.
you want
But
that to work in your
yeah,
favor, not
in your
against
favor,
you.
not in your favor, right? So I tell
Right.
people like reverse mortgage is like reverse mortgage in reverse. Like literally, you owe more every month, and it compounds more every month. But I was shocked at how little, like considering that my parents had like $1 million in equity in their property, I believe, right, somewhere around
Mhm.
there. I was like, they would only get like a couple 100,000, maybe 250, based on their age and something else like
Yeah.
that. So, and then they'd be looking at selling like essentially very shortly thereafter if they were depending on that money.
Right. And the closing costs are relatively high as well.
And that was the other thing that was shocking
The
to me. I
interest
was I
rates
was
are
told
low.
like 30 grand in closing costs, right? Which
Right.
is like, why is it so much for closing costs on a reverse mortgage? Do you know?
And also, if you look at it right now, most of the people that have a mortgage already have a fairly low interest rate, and
Yes.
reverse mortgages tend to have high interest rates, like 9% plus as of the current date of recording. Most of them are north of 9%.
Really?
So if
So
you
now,
have an existing mortgage at 3%, let's say you have $500,000 of existing mortgage, and you just want access to another, couple $100,000 of the equity to pay for care or retirement needs, whatever it is, you have to pay off that entire 3% mortgage with a new one at 9 or 10%. So there's lots of reasons. I mean, and I don't mean to bash reverse mortgages, because I do think there are some circumstances where they are very helpful for families, and our company offers them as well. But usually, for me, if I have lots of choices, if the client can qualify for lots of different things, that's not the first on the list, in my opinion.
right.
Other people may think differently, but that's my personal take.
Okay. Well, so what are the alternatives to a reverse mortgage then? Like, what do you do? Like, if you don't want all that, like those high closing costs and the
Mhm.
negative, compounding
Negative
interest,
amortization.
yeah,
Yep.
what do you do?
So the key is that, and this is why not most lenders don't focus on this type of financing. The challenge is that seniors aren't working, right? If they're moving into an assisted living community, they're not getting a second bedroom to run a side gig out of, right? They're not running a business out of that. So the key to being able to help families get through this process is to make sure that you have programs that are not driven by income, that meet this typical profile of a senior who's not working, maybe house rich, cash poor, needs to raise capital to pay for care, but also doesn't want to lose the equity on a compounding basis. So it's not a one size fits all product, and every senior is different. I can give you a couple of examples of things that we've done, but one, let's take your parents as the example, right? They wanted access to some of the equity in their home, probably would prefer to not pay off the existing lien that may have been at 3% with a new 9 or 10% loan. So what we would do in that case, we have a HELOC product, for example, where typically a senior might not qualify. And we actually had this, what you've described is almost the exact scenario that we did for another client who was their financial advisor was ideally trying to help them avoid a reverse mortgage. Fortunately, they called us. They had already been denied for 3 HELOCs because HELOCs are actually harder to qualify for than conventional loans. But we have a unique niche where if the senior has some money set aside in retirement accounts, we can use those retirement accounts and the value of them to add additional income to the loan application. So they don't have to move the money, they're not using it as collateral or anything like that, but just having it. So this person happened to have about 350,000 in an IRA. That was really her nest egg and was definitely not going to last long enough to pay for care, but she wanted another 250,000 or so of equity, but she had been denied by all these lenders for HELOCs. So this particular niche with the 350,000 that she had in retirement assets gave us an extra $10,000 a month of qualifying income, which was all the difference she needed to be able to get a basic, simple line of credit, as opposed to having to replace the entire loan and do a reverse mortgage. So it's little niches like that we pull from all the different sources of funding that we have that solve one little problem that we see commonly. And we've gone out and actually sought out products and help create and adjust guidelines for some of the lenders that we work with to be able to accommodate this type of need. We saw another need where people are moving into assisted living. They may need a $50,000 to $100,000 pretty small line of credit that we now have a program that we could close in a matter of days. So there's lots of different products that solve different needs, but the key is that to be able to lend in this space is that you can't have standard programs where people are being underwritten the same way as a working adult would.
Right. So you mentioned a HELOC. So tell me about these HELOCs. So like, what's the
Mhm.
most that you can get on a HELOC? Is it depending on how much your property is worth, or depends on
Mhm.
how much retirement income that you have that can be converted to an income stream essentially to make the payments? How does that work?
Yeah, it's a combination of different guidelines. So our most aggressive products will let you leverage up to 90 to 95% of the value of the home. I don't recommend that, because if you're at 95% of the value of the home and eventually you want to sell it, you might have to actually write a check to the lender to pay off the lien, because you got the broker's commission to Seb, of course. You've got your transfer taxes or whatever costs, escrow fees, whatever it may be. You're not going to have enough equity left to be able to pay all the standard costs of selling. So I don't recommend going that high, but technically speaking, programs do allow for you to leverage that much. And sometimes the loans that we do are actually to help people fix up their home to prepare for selling. Could be a shorter term bridge loan or bridge HELOC. So there's lots of creative ways that we do that. But they'll usually go up to a line of, maybe if it's a line of credit, 500,000 to 750,000 is usually about average, and up to potentially stretching the limits up to about 95% of the value of the home. Compare that to a reverse mortgage where they're going to cap you closer to 50%. It's a huge difference.
Right. So, what I come across sometimes too is that people took out a reverse mortgage like years ago, maybe, and then
Mhm.
they're at the end, right? There's no more
Right.
money that they can tap, and so they want to basically they need more money essentially, and there is a lot more equity in their house now because maybe their
Right.
house doubled in value since they took out their initial reverse mortgage. So, are there options like I mean to like I guess a HELOC could take out like a first mortgage, right?
Sure.
But what if for whatever reason you didn't fit the HELOC guidelines? Are there
Mhm.
like loans that are basically first position mortgage loans that you can take
There
out
are.
that would pay off that? And like, how would that work?
There are, yeah. So usually banks don't want to go in second position behind a reverse mortgage, because then they're losing equity and their exposure on that property is getting worse. But I guess when you come to the end of that road, they might potentially consider it. But you, the other option is to pay off the reverse mortgage with another loan instrument, whether it be a HELOC or a first mortgage. And HELOCs can go in first position. So just because we say the word HELOC doesn't mean it's behind another mortgage. But we would look at, the needs of the family. How much capital do they need? What's the payoff of the existing loan? We have programs that don't require a statement of employment or income, which is it solves the problem for seniors. And those programs can usually go up to 70 to 75% leverage of the home value. So if you're stuck at 50% with a reverse mortgage, and let's say you've got a $2 million home, with $1 million loan on it now because you've used it on that reverse mortgage for a while, you could potentially get access to another $500,000 to pay for care. So there's lots of different solutions. Some of them are, the beauty of a reverse mortgage and a HELOC is that you kind of draw it as you need. Some of the other programs would be a lump sum distribution where you take out, let's say, 75% of the value of the home. You get that money, but the beautiful thing about that is if you're working with a proper financial advisor or professional, they can invest that money for you to make it last longer, because that's the key for seniors, is making the money last, because people are aging later, they're living longer, the cost of care is only going up, and so people need access to more liquid capital. It's great to have the home, but you need a way to be able to access the equity if you don't have enough capital yourself to be able to pay for that. So the name of the game from a financial planning perspective and a lending perspective is to find ways to make that money last longer.
Yeah, so let's just say that I took out a first mortgage loan, not a HELOC, just one lump sum distribution, and let's just say it was $750,000, and maybe my house was previously paid off, and so I have this loan for 750. So,
Hmm.
like that's obviously going to cost a lot per month, right? Like, because what's the
Hmm.
interest rate on something? Because you're saying like you don't need income to qualify, like W-2 wage income. So, like, I mean, are the interest rates a lot higher, or what are
They
the payments
can
going to be like
be,
on that?
in yeah, in some cases they can be. I mean, they vary depending on the qualifications of the individual. But there's also programs where you could have a family member co-sign, where now you're going back into more conventional interest rates, where you'd be paying a market interest rate. But the idea behind the lump sum distribution, or the funds that you get out, you the hope is that you can invest that money over time and have it offset the cost of interest, maybe even cover the cost of the interest, depending on what your rate of return is by investing that money. But what you're doing, if you compare that to a reverse mortgage, is now you've got all the capital that's working in your favor, and now it can compound in your favor, as opposed to a reverse mortgage, which is compounding away from you. So that's one potential benefit of it. But the idea is that you have access to the capital when, if and when you need it, and it's working in your favor rather than against you.
So
So
you,
interest rates can vary, depends again on lots of different factors. But the point is to put yourself in control of that process. And you can also, similar to a reverse mortgage, but a little bit different way to get there, is you can cash out that 750,000 in this example. And this is part of what we go through with families, is to figure out, okay, how much money do you need over time? This is something we really try to engage with a financial advisor on, because they'll be able to tell the family how long that money will last them. But it's also, okay, how many months or years of payments need to come out of that 750,000. So when we determine the amount that the client may want or need to cash out, it's inclusive of what the mortgage payments are going to be over that period of time. So you're cashing out the money to make the payments with the mortgage, so that you don't have to, lose the equity on the compounding basis, or that you might be able to get access to more capital than you would on a reverse mortgage.
yeah, so you mentioned a financial advisor. So, so let's just say that I take this 750 out, and because I'm having my adult child co-sign for me, and they have the income that the mortgage rate isn't much more than like 7%. So, well, how can I? And I take that money and I invest it somewhere to like cover the interest, and then give me a return above that to help pay for care. How do I find somebody that I can trust who knows how to handle a situation like this? Do you have people that you recommend, or do you go to
I
like
do.
TD Ameritrade, or like what do you do?
Don't do it on your own. That's the advice. Don't do it on your own. Get a professional who, in my opinion, is not tied to any specific investment from any company, who works in more of a, unbiased type of arrangement, so that they can put the money in a place that makes the most sense. It's not a coincidence sometimes that when we have clients who have a financial advisor with like a large financial firm, that most of the investments are placed through funds that are part of that financial firm. And I'm not saying those are bad investments, but there's a high percentage of them, ironically, that match the company of the person who's managing the money for them. And maybe they get some benefit from doing that, for the senior or for themselves. I don't know, but I'm a fan of the independent, financial advisors, and we have some in our network who are great, that specifically focus on the needs of seniors. So we have some great referrals. We've interviewed a number of them, and I think also people don't necessarily understand that there are lots of different types of advisors. There are some that will charge you what we call assets under management, which means a percentage of your investable assets, but they don't want to see your money declining over time, which is basically what happens when you're using those funds slowly but surely. But there are also ones that are what we call fee only advisors, who may, some of them just charge hourly for giving advice. Some of them may offer that, financial planning advice, but also do investments. So it's a matter of finding the type of advisor that you think is right for your own needs. And I'm not saying any of them are good, bad, or better or worse, but just finding the one that you feel most confident in to help you navigate that, because it's a really tricky situation. There's a lot of factors. There's some great technology out there that can help a good advisor figure out how long these funds are going to last, and what the best use of that equity might be.
So when you say like an advisor, like are you thinking like a CFP here? I mean, like a
Yeah,
certified financial planner. I mean, like, do you work with a lot of CFPs? I know on
yeah,
your podcast you've talked to quite a few.
we have. Yes, that's a big thing for us. The financial advisor is really the quarterback of your financial planning. They're the ones that may help you figure out all the other components and understand, if you take this action, how is it going to impact everything else? So they have a global view, and they may engage, depending on what resources they have internally, they may engage with other professionals like a real estate agent, a mortgage person, an estate attorney. But usually the financial advisor is the quarterback of all that, or at least guiding you on what professionals you need to talk to and hopefully giving you good referrals for those. But we're big proponents. I'm a huge proponent of people having financial advice at all stages of life, not just as you age, because the key is to plan ahead. So if you want to benefit from compounding, or you want to invest, you want to benefit from the appreciation of real estate over time, right? You said never sell. um, the longer you have those investments, the more it compounds in your favor. And so the earlier you get involved with a financial planner, even in your 20s, even if you don't have, as they say, two nickels to rub together, there are advisors who will still work with you even though you don't have millions of dollars to invest. And those are the types of advisors that different clients need different types of advisors based on their profile and based on their specific needs. Some of them may just need help with one big decision, or they might be inheriting money and not know what to do with it. And so it's kind of like a one-time thing. And some people want someone to invest money for them over the long haul. So we really try to tailor our referrals to financial advisors to match the needs of the client. But in the senior space, there are some that we work closely with that specialize in the common challenges that seniors have, and helping them navigate those things and different benefits that may be available to them. And some of them are involved in Medicare planning and state specific programs and things like that that can be really helpful to supplement what you may be doing in other financial parts of your life.
Oh, that's terrific. So you have financial planners and advisors who are versed in all these like Medicaid, Social Security, and are able to come up with the best mix of, I guess, different investment strategies for the senior client.
Exactly. And a lot of times they'll engage with other professionals. Like there are some people that just specifically focus on Medicare planning, Medicaid planning. And because there's sometimes a multi-year look back at your finances to see if you'll qualify for those programs. Now, if you're at that stage, you've pretty much run out of assets, so maybe you don't own real estate anymore. But that's what a financial advisor will help you do. They'll also help you avoid some of the big mistakes, like the example I gave of the family that paid the IRS $1 million unnecessarily. That's something that a good financial advisor or estate attorney would have said, wait a second, don't do this. Don't sell right now, find another way. And if they're fortunate enough to have a lender who understands how to pull out the equity that they need to be able to help that family, now you're talking about saving the family hundreds of thousands of dollars, where instead of that money going to the IRS, it's now going to their family or their favorite charity or their church or synagogue or temple or whatever it may be, but it's going to the place that they would really rather have it be. But if you don't have those advisors, you're operating in a vacuum. You don't even know that these challenges exist, and you might say, well, selling my home, cost of doing business, I just got to write a check for $1 million to the IRS, and that's just how it is. But that's not necessarily how it has to be.
Right, right. And when I say never sell a house, certainly never sell a house before you enjoy that step up in basis.
Right.
That that certainly is
Exactly.
crucial. But one thing that, like, sort of, makes me think is that you keep on talking about like, oh, it's better to start planning early and like, like don't just wait to the last minute. A lot of people do wait to the last minute, and a lot of people don't think about how to access this equity until they have like a crisis, right? Like
Right.
maybe somebody needs to go into a home, like maybe like they're a married couple, and then one of them has a fall and needs to go into a skilled nursing facility or something like that. What do you do if you need to have a lot of money like right away, right? Like
Yeah.
immediately. Like, I mean, do you have
It's
options
tough.
for that or?
Tough. Yeah, there's far less options for people when you have that type of situation. Whereas if, for example, you had opened a line of credit before you got into a crisis mode, first of all, it's easier to qualify because sometimes the crisis mode is not necessarily purely financial, but it's medically driven, and that can be with people who are aging. Sometimes that's memory care issues, and then you have the whole issue of being able to actually understand what documents you're signing and how to that your lender actually believes that you have the mental capacity to understand the documents that you're signing. Because if the notary comes to your house and they say this person clearly is not, doesn't have all their faculties, so to speak, they will not let that person sign on the loan. And then you're talking about far less attractive financing options. So if that, in that example, if somebody had done a line of credit, they may have been able to just make a draw on the line of credit, which is immediate. You could write a check on, without any advance notice. Whereas if they wait to do that until the situation is so dire that they need money immediately for an unexpected item, and you're talking about a mortgage product where you need to pull out a good amount of equity, that's not so easy to do on very short notice. Now, we have some programs that are flexible in that way and will allow us to be able to accommodate people fairly quickly, but they're less attractive than if they had planned ahead and opened up, for example, a line of credit, a year prior or 5 years prior. So I'm a huge fan of the line of credit because it just gives you access to the equity, but if you don't use it, you're not paying for it. And that's a huge tool for families that want to prepare for the potential for some sort of medical situation where they need money quickly and don't have it, or maybe it's invested and it doesn't make sense to liquidate those investments. Because when you're using your money from investments accounts, as soon as you pull that money out of the investment, you're paying capital gains, and you may have bought those investments 20 years ago. You just never know. So there's a lot of tax implications. There's a lot of just access to liquidity considerations where the loans you can get in that pinch of a dire situation are far less attractive than had you opened up a line of credit in advance. So that's why the planning ahead is so critical.
Yeah, but so a lot of people don't plan ahead,
They
frankly,
don't.
at all. Like I
Yeah.
come across this all the time, and literally, like they might have a small pension, they have Social Security, and then they have the house, and that is it. But they don't
Right.
have enough cash flow to cover any significant medical, like a skilled nursing facility, or maybe they need to go into memory care or something like that. But
Mm-hmm.
so if somebody does have an issue like that, where it literally is an emergency, they can call you. How soon do you think they could get like? I don't know, $50,000 to tie them over for 3 or 4 months.
I
How
mean,
long does that take?
we have some programs that are very tech driven, would probably require an adult child to navigate that process a little bit. That's usually where we solicit some help from a family member if they are fortunate to have one. But some of them can close in a week or less.
In a week or
So
less.
yes, so they can be
Okay.
pretty quick.
All right.
But again, the
It's going to
devil's
cost
in the
you.
details. So if that senior has issues with mental capacity, that makes it more difficult. If they have a trust, for example, let's say they've now moved out of the home and they have a trust, we can do loans to a trust. So we've tried to create products that fulfill every need of seniors. So the starting point of that spectrum is you have your empty nesters who are downsizing, let's say from a house to a condo. They don't need the 5 bedroom house anymore. They need bridge loans to try to help them buy the new property. And then you have people who are looking to either move into a senior community or potentially pay for care over the long period of time that might need a different solution. Then we have solutions for people that have these types of medical emergencies that you're talking about where they need funding quickly. And then we also do loans for a trust where the loan is actually made to the trust itself. And those can happen pretty fast as well. If somebody has a trust established, if they don't have a trust, obviously a trust loan is not an option. And then even for family members who maybe the estate for the senior is delayed in settlement or potentially stuck in probate, and the heirs to that estate are wanting to pull out equity, maybe to fix up the home, or maybe to, maybe the adult children thought they were going to have their inheritance money, so they committed to buying another house for themselves with that inheritance money, but then there's a delay with the estate or the probate, all of a sudden they don't have the money. We can pull equity out from that. So there's like a whole spectrum of financing solutions that we have. But the best ones, the ones that will be most appealing to a family, are ones that are not done in a crisis.
Yeah, definitely. Now, you said something very interesting there. You said you can get loans to trusts, and there's
Correct.
revocable and irrevocable trusts.
Yeah.
And I have heard about loans to revocable trusts, but like
Mhm.
irrevocable trusts are a common tool I think people use to shield assets from Medicare, right? So that, or Medicaid, I guess, right? So that they can, have that not count among their assets, right? So can you loan to an irrevocable trust as well?
Yes. Again, far less attractive financing terms for something like that because it's higher risk for a lender. But yes, we can do those either shorter term or longer term. And you're right. Sometimes people use those as a shield of the assets, but also sometimes it's part of the inheritance from a family member where they were, where their parents, let's just say, wanted to dictate how the funds that they were giving to their children were disseminated, and they didn't want anything to be changed. So they set up an irrevocable trust. So, yes, the short answer is yes, we can do those types of loans as well. Those are less common because revocable trusts are just naturally more common than irrevocable because of the nature of the restrictions that the irrevocable trusts typically have.
Right. Okay. And are these loans to trusts, are they expensive, hard to do, or are they, fast and easy and cheap, or
They're
a
fast and
pain?
easy, not cheap. So usually those would be the equivalent of like a hard money loan.
A
So you're
hard money
looking at
loan.
double digit interest rates. Yeah, because they're what we call non-recourse, which means there's no individual person signing on the loan to guarantee the loan personally. So what that means is that the bank is basically giving the loan just based on the equity of the home, not based on any personal financial criteria. And usually, the further you get away from the center lane of documenting everything, income, assets, credit, all of that type of stuff, the further you deviate, the worse the rates get. So if you're talking about non recourse, that's the farthest end of that spectrum, where it's going to be probably one of the most expensive loans. And if you add an irrevocable trust to that, it gets even a little more expensive. But you're looking at more or less hard money terms for those, double digit, 10, 12% interest rates, usually points involved because they're risky loans. But sometimes that's far better than paying, $1 million of taxes in capital gains. Maybe it costs you $50,000 to get the loan, but it's a heck of a lot better than paying $1 million to the IRS.
Right.
So, it's a cost benefit analysis to see if that type of loan makes sense. It's certainly not right for every situation by any means. But there are situations where a family needs money, they need access to capital, and the state hasn't settled, or the senior who needs money for memory care doesn't have the mental capacity to sign on their own behalf. But they need to move into a facility where a reverse mortgage is not an option in that case because of the owner occupancy requirement. Sometimes that could be the only saving grace for being able to do it and not having to sell the home. And sometimes you also get people who want to try out assisted living or senior living, but they're not sure if they're going to like it or if they want to come back home. So sometimes they choose not to sell their home, but they need capital to be able to move into the assisted living just to try it out for 6 months, see if they like it, or if they'd rather age in place. So the flexibility of these loans allows people to kind of make those decisions not based on their mortgage, but based on their life situation.
Okay. So the lesson here is plan ahead. So how far should I be planning ahead, right? So, like, let's just say that I retired, I'm 65. Should I take out a HELOC at that point? Or, like, what can you do
Yeah,
to plan for future needs, assuming that you don't
yeah,
have like a big pension or SEP IRA or Roth or something
right.
like that, that your house is really your primary asset? What do you recommend?
I mean, this is where a financial advisor needs to weigh in because it would be out of our scope to tell people how to plan for the rest of their lives. We can tell them what vehicles we have and what the benefits may be of doing that, but as far as how it makes an impact on other things or how long their other assets may last, if they're 65, 70 years old, they're probably maybe recently retired if they're retired at all. So there's a lot of other factors that kind of go into that process. But in general, a line of credit usually you can draw on for up to 10 years. And we have absolutely come across situations where we had one recently, a really sad situation where husband and wife in their early 60s, the husband had a major stroke and is now going to need 24-hour care for decades, probably. And they had, $1.5 million, $2 million in a retirement account, but it was not going to be enough. But they had a very valuable home. This one happened to be in Santa Barbara, that they needed to tap into equity. So we worked very closely with a financial advisor to figure out what made sense, how much financing they should pull out, and under what vehicle, so that they could make that money stretch as long as possible. And also so that the wife, who was fully healthy and still working her part time job, didn't have to actually leave the house just because her husband had had this stroke. She wanted to stay home. So that circumstance would have led to a different type of loan than somebody in a different circumstance. So it's not, what we do is not one size fits all. It's not the same for every client. It's a different potential product, different loan amount, different time duration. There's all sorts of factors that go into that, part of which is what other means they have. So if they have other investment accounts that are fairly valuable, they may not need to pull out a lot of equity, and maybe just a line of credit to have access to funds in the event that they need it is the right solution. But you don't actually have to draw on it. So again, every situation is different, but this is where the financial advisor plays a pivotal role in trying to help us figure out what the right mortgage solution is and how that's going to potentially solve the future challenges that that family may face.
Okay, terrific. So let's just say that someone's watching this video and they need some money right now, and they are a senior. Their first call is to you or a financial planner.
I say let's do a conference call, but I think in reality the best execution is the first call should probably be to the financial advisor. Let them get an assessment of what your current means are, and identify that there's actually a shortfall in what you may need. You don't want to just get a loan just to get a loan, right? There should be a purpose for it. We're not looking to close loans for people that don't need them, or that can't benefit from them in a meaningful way. So probably first call financial advisor. Then if and when you identify that there is a shortfall in your projected expenses and needs, that's when you start looking at the financing as a potential way to fill that gap. But I would say financial advisor first, estate attorney and mortgage person probably tied for second.
That for a second. So, but you mentioned a financial advisor, but I think that a lot of people, they have like Schwab or like, TD Ameritrade or something like that. They think they have a financial advisor, but is that the best person to call?
No. Usually if you're not talking to the same person every time you call, that's a sign you're not really getting proper advice, or you're given tools to figure out investing on your own, or reports. The It's not the reports or the tools that you get that help you make the right financial decisions. It's the advice on how to use those tools and research that actually help you. So I'm a big proponent of the independent financial advisors. I think they have the least vested interest in where you decide to put your money, and therefore, theoretically, they should give you a result that's unbiased. Not to say that people that work for large firms are biased. There's a lot of great ones who I will refer to as well. But if you're just starting out and you want an independent view, I would say the fee only independent advisors are one of my favorites.
So where does one go to find a fee-only independent advisor then? Is there like a website you can go to, or
Yeah, I mean, usually what I recommend, because even if you're listed on a website, doesn't mean you're very good at what you do. There's a lot of people that are listed on mortgage websites that shouldn't be, in my opinion. I'm sure same with real estate. Um, but referrals are really helpful because there's a frame of reference. Maybe they've helped somebody in a similar situation. So ask your network, ask your family members. You certainly could ask us. We have people, in all parts of the country that can help people through these decisions. But the referral is really critical because then you have a frame of reference that they're actually good at what they do.
okay? And then one thing you said a couple minutes ago was that you don't want to get a loan just to get a loan, but then I'm thinking like the guy who had a stroke, right? They didn't know they needed a loan, right?
Right.
So should I mean, what do you do? I mean, like, do you get a HELOC? I mean, you said you're a big fan of HELOCs. Like, should you just open a HELOC even though you don't actually need the money today, just in case for a rainy day or whatever?
It's never a bad idea. I did that for myself just a few years ago, and I'm glad that I did. The mortgage industry took a bit of a dive when interest rates hit 8%, went from 3% to 8%, and it was very helpful just to have the peace of mind to know that we could pull from it if we needed to. People can use it for real estate investments. They could use it to pay for repairs to their home. Like it's an open line of credit to use for whatever you need. So yes, I am a fan of people having access to a line of credit against their home for unexpected expenses. But sometimes you don't plan ahead and you still have some sort of crisis moment and you wish you had planned ahead, but that's not the reality. So yes, in general, if it's a line of credit, there's not much downside other than the small amount of initial closing costs, but the peace of mind that it can give to a family, especially in those moments that you don't expect to happen, can be it can be a lifesaver. You can pay for the care that you need that you might not be able to pay for otherwise, or it may be that you start to become a burden on your family members where somebody else is having to foot the bill for you. Maybe your adult children are having to now come out of pocket for your $10,000 a month of assisted living. They're having to pull money out of their own accounts to help support you. That's the thing. Nobody wants to be a burden on their families. A line of credit is one way to avoid having that happen.
Right. Okay. And again, so you do have HELOCs that will loan to a person without a W-2 income. Is that correct?
Correct. Yes.
Right. And okay. Well, I think that's important to know. And you wouldn't get a HELOC for like an irrevocable trust, would you? That's not a HELOC,
No,
is it?
that's a whole different type of
That's a whole
financing.
different
Yeah,
thing
that's
entirely,
usually a
right?
lump sum
Right. But
distribution.
a revocable trust, you can still get a HELOC. Yes.
Yes,
Yes.
correct.
Okay. All right. Very good. So, are there any common questions that people ask you that I didn't ask you that it's important that people know about?
I mean, we talked a lot about reverse mortgages. I think the common misconception is that that was the only option for seniors, and maybe until more recently it was. Certainly the most popular and common, but they're very polarizing. People either love them or hate them. In most cases, there's not much in between. But I would say just work with a mortgage advisor who understands all the different options. Everyday mortgage people are not thinking along these same channels of how to help people. So I would say that's the key is you need a specialist when you're dealing with these types of issues or planning for these types of potential life changes. You need somebody who really understands how to lend in that situation. And that could be also true of financial advisors and real estate agents and all these things because we've seen real estate agents who let's I don't even know who the agent was. Let's just say the person that sold that home that ended up having to pay $1 million in capital gains. Maybe that agent didn't know about the step up in basis because they're not a specialist in dealing with issues related to seniors. It may have been your gatekeeper to avoid that issue may have been the real estate agent if the real estate agent was aware and cared enough to say, hey, maybe don't sell this home now, let's sell it in a year or 2 years. So you need those specialists who know the nuances of the tax code and the financial planning and the mortgage lending and all these types of things that can give you the advice that the average professional isn't going to know, or is it's just not going to be in their frame of mind. So I would say specialists all the way around are really critical, and making sure that people not only can sell a home, can do a mortgage, can provide financial advice, but there are people that actually focus on your type of situation or your type of circumstance that you may be in or trying to prepare for.
Got it. Okay. So, Mark, thank you so much. You certainly are an expert, I think, in this field. I think that's clear, having talked to you before and just now, and from listening to your podcast. So, if people want to tap into your great well of knowledge, what's the best way they can get a hold of you?
Sure. So our website for anybody, any seniors or families that want to learn more about options and when these circumstances may be beneficial, we have a website, seniorfinancingsolutions.com. And then any professionals who support seniors, we have a separate website, which is financingforseniors.com. So any of those websites, you'll find us. All of our information is on there for my team and I. And yeah, we come from a place of service. So even if it means we tell you don't do any loans, we'll always give people honest advice. But that's a great way to find us.
All right, terrific. Okay, Mark, thank you so very much. I really appreciate your time and look forward to speaking with you soon.
Sounds great. Thank you for having me.
All right, thanks, Mark.
Okay, bye bye.